Welcome to the USA Financial Trending Report podcast, a candid and educational discussion regarding the state of the markets, economy, and other factors that may impact your investment accounts. The host of this podcast is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. This podcast is educational and not intended as personal financial advice. Seek the help of a qualified financial professional regarding any strategies discussed. Investing carries an inherent element of risk and includes the potential for loss of principal and income. Past performance is no guarantee of future results, and your actual results may vary.
Hey, as we always like to say, trend lines beat headlines, and we have had a huge request for the trend report to come out maybe a little more often, given all that's going on in the market, in the economy, interest rates, inflation, market performance and volatility, and so on. So we're going to try to up the game a little bit, come at you with a little more information on a more rapid basis, and I'm going to pivot off of our formulaic analysis as a way to keep you kind of up to date as we move forward. So there's a few things I'm going to do on a general basis as we kind of get into this on a more regular routine than just quarterly. And what I'm going to do is I'm going to look at the capitalization of the market, and we're going to rank it and score it with our formulaic analysis, both at a micro and a macro level. And then we'll look at the sectors within the economy and the market. There's 11 sectors that basically make up the S&P 500, and we will score and kind of rank those from an analysis standpoint as well. And then we'll generally probably touch on another trend or two. Today we're going to spend a little bit of time taking a look at where inflation truly is from a historical perspective, so you can kind of wrap your mind around what's going on today versus what you've experienced in the past in your own lifetime, or prior to your lifetime, depending on what your age is. So here we go. I'm going to share some screens with you. You can always get this PDF from our website. I would imagine and recommend that you would want to have this, but I will flash it up here on the screen as we talk through this. Okay, so the first thing I should mention is that we are looking at data ending July 8th, which is last Friday from when I'm sharing this information with you, and we will move forward from there into the capitalization, just as I had mentioned. Let me get rid of that drawing there for you. There you go. So here we are on the capitalization screen, and on the left we have the macro, and on the right we have the micro. Make this a little bigger so hopefully you can see me a little better. So we have the macro on the left, we have the micro on the right. And generally speaking, the macro probably carries a little more weight than the micro does, but the micro is important because it kind of shows us what's happening in kind of a more current setting, and it often will identify where things are moving, and if it continues in that direction, then ultimately it kind of takes over the macro, if you will. It builds that data. So from a macro perspective, a couple things to keep in mind, which are really interesting and unique right now. Here we are. Excuse me, my pen keeps turning off. Here we are with the 1 to 3 month T-bill, which is essentially cash. So cash is ranking in the number one spot on the macro. And that's not a good thing. That means that all the stock market, even the bond market, is falling below cash. Now, that's been what's very unique about this current environment. Normally, there's more of a teeter-tottering effect. If equities are up, then debt or bonds are down. If stocks and equities are down, then debt and bonds are up. And what we're seeing is while bonds are up here in that number 2 spot on the macro, they are not ahead of actual just outright cash. And if you look over here, you'll notice that it is showing a negative number on the macro, as is cash as well. We're seeing negatives across the board on the macro level. Again, not a normal thing, not a good thing that we're seeing all of that red. Now, if we come over to the micro side, again, this is the micro side over here. If we come in, we look at Bill's bill there, the ETF bill, which is the 1 to 3 month T-bill, you'll see down here in the number 15 spot, this is what's going on with cash. So it has done a bit of a flip on the micro. Again, this is the micro column, and you'll notice we are seeing some green over here on the micro. That's a good thing. That means the market has started to pick up, at least in that short-term window ending as of last week. So here is the overall market itself, ranking in the number 8 spot right here on on the macro side, and it moves up to the number 5 spot on the micro. So that's a good sign. But we also saw the bonds. The bonds drop down here to number 8. And then down here at the very bottom on number 15 on the left-hand side, this is where we've got our total international representation. Just so you can get an idea of how is the U.S. market comparing to the overall international. And as you can see, international is down at the very bottom, and it ends up at number 14, just above cash, even on the micro. So what we are seeing right now, as of the data ending last week, is that the short-term data is starting to build some momentum. It's starting to build some strength. We don't know if that's going to sustain. The overarching scenario on the macro level is still very negative, but we are seeing some glimmers. Now, we've seen some glimmers in the past. It doesn't mean the micro is going to fully grab hold, like I said before, but at least it gives you an idea. The other thing that's of note is look what's kind of surfaced to the top over here on the micro side. We're looking at large cap, basically large cap growth on the S&P 500 right here. QQQ, that's the NASDAQ 100. And then we see just the straight out S&P 100 and the straight out S&P 500. So the big stuff, so to speak, has gone to the top of the list. Down at the bottom, we've got ourselves small and mid cap value down here, and we still have small and mid cap value down here on the micro. So it tends to be the larger cap and slightly growth oriented, which is leading this charge right now. Now here, if we jump to the sector viewpoint, here we're now looking at the subsets within that S&P 500. Once again, we've got cash sitting up here at a top spot. Sorry, my pen keeps turning off. We have cash sitting up here at a top spot. We do see it drop down to the number 14 on the micro side. We also see a decline in those bonds. So again, it's telling us that some of the short-term side of the market is starting to pick up. And then here's what probably interests me the most is what's actually leading that charge. We're seeing healthcare, consumer staples, telecom, consumer discretionary, and then information tech are the sectors that have jumped above right here, the overall stock market. So the overall stock market has taken one slight little jump up, but it's changed what's up there. So we did see healthcare was up here before. We saw some consumer staples, some utilities, and some telecom. Utilities has dropped down. But some of the others have kind of filled up with that. And then again, here's our international market, again, bumping itself up just a little bit. So way down at the bottom, this is very interesting as well. Energy is in the bottom spot on both sides, both macro and micro. If we would have been having this conversation just a few weeks ago, energy would have been in the number 1 spot. It ran hard and it fell hard. And so that's, again, has a lot to do with what's going on in Ukraine, what's going on in Russia, what's going on with the oil scenario, and the energy, obviously, pressures that are taking place, which kind of brings us into inflation. So let's talk about inflation for a moment as well. So here's we get inflation. As you most likely are aware, we're running up against some historic numbers again. So here we have inflation since 1980, and we have inflation over the past 10 years. I think it's important to look at two different views so that you can kind of get a better perspective. When we're looking at over the last 10 years, here we are at over 8% inflation. And you can see this huge spike up that's taking place right here. It ran up fast. This is really the pandemic that's taking place right here. Now, contrast that with what we see on a longer term basis going back into all the way back to 1980. Obviously, here is the high mark in 1980. Here is where we stand today. So we are seeing, not the worst that we've ever seen, but it's cranking up and it's cranking up fast. And that's obviously got people scared. And I've heard some economists talk about the fact that it is highly energy driven, more so than we normally see in inflation, which I, again, find kind of interesting in the sense that because of oil prices, because of gas and energy prices, because of Ukraine, because of Russia, because of the pressures that were kind of unassumed in the marketplace prior to the atrocities in Ukraine, what we're seeing is that the pressure on energy costs going up so quickly, it ends up kind of disseminating and influencing so much of everything else with inflation. And so I've heard estimates. Now, again, these are economists, and they're sort of throwing darts at the wall. They're making some general comments, but I've heard things like that the inflation is being driven, say, a third, 33%, all the way up to a half, 50% of inflation is coming directly from energy. Now, what do they mean by that? So the concept is that energy costs see themselves come cascading down through the rest of the economy. So in other words, if I'm a semi-truck driver and I'm running my 18-wheeler and my job is to get stuff from point A to point B, I don't have the opportunity to sit at the roadside truck stop and negotiate what I'm going to pay to put diesel into my vehicle. I just have to get diesel in it because I got to do my job. I got to get from point A to point B. So that higher diesel cost, which is running $1 or more higher than regular gasoline, which is also unusual. Normally diesel costs less than gasoline, by the way. Now we're looking at diesel, a buck and a half higher than a gallon of regular gas. So that cost gets incurred into the distribution. So that, not even counting the creation, energy is needed to create the products. Then we now need this energy cost to distribute it. And then that distribution cost goes up, which ultimately affects the retail pricing. And then that filters all the way down into the products themselves, obviously. So I'm probably not sharing anything you didn't already know. I'm just trying to show the logic pattern of what's going on with this inflation. So now the other thing that's kind of interesting here is right in this area, that is the financial crisis. So you'll notice down here, here's 2008. So look at that spike up before the crisis, and then that spike down during the crisis, and then the rebound. Here is the pandemic. We see a little bit of a spike down, but now we've got this huge spike up. So this is what's so different. Again, this is getting really messy, but this is what's so different right in here on both of these graphs. So the past 10 years, we are extremely higher. So we were in like the 2% or even the 0% range during periods of time over the last 10 years. Now we're over 8%. Historically, we hit a high back here in 1980 of almost 15%. So we're not to the worst case scenario, but again, that was a mess. That was an absolute mess. If you're old enough to remember the lines, again, let's talk about gas. The gas lines, waiting to just put a tank of gas in your car, and all the things that were going on during that era, it was a mess. And then we saw it come down quite rapidly, and then get a little bit more normalized over time. Now, again, if I was to clear all this, which actually I will do for you, if I'm to clear all this, now look at, we are seeing a general downgrade or downtrend across that inflation until we hit this now new spike. Now here in the most recent, we saw it running pretty flat. It dropped down and it came up, but overall it was relatively flat again until we see this huge spike. So these are creating some unique scenarios that the Fed is dealing with on how they're raising interest rates and how they're trying to stop inflation, potentially with even risking a recession. Some people will argue we are on the verge of a recession. Some people think we're already there. I don't think we're there yet, personally, but I do think that the odds are pretty good. I've heard people saying the odds are, about a third right now, so 30 some odd percent that we might be entering a recession within the next 12 months. That doesn't mean tomorrow, doesn't mean next month. It just means these are the momentum that is gained in the market. Now, the good news is, right, is the glass half full or is the glass half empty? They're also saying then that 70% chance that we're not going to go into a recession. So again, the trend lines beat the headlines. Keep an eye on what's going on in the market, in the economy, some of the other notable trends, which I'll continue to bring to you as we discuss this stuff on an ongoing basis. I hope you found this helpful. Thanks again for your time today. And thank you for just trusting us in helping you with your financial future.
Thanks again for listening to this episode of the USA Financial Trending Report. To gain instant access to this monthly Trend Tracker publication or to find out more about USA Financial Formulas, simply visit usafinancialformulas.com. Any USA Financial Formula strategy may underperform or produce negative results. The strategies and screening tools discussed in this presentation are only tools designed to move assets into or out of the market based on various economic and market indicators. These tools do not guarantee specific results, and even with the application of these tools, it is possible that your account will lose value. Research partners mentioned are independent companies and not affiliated with USA Financial Formulas. You should only invest in the USA Financial Formulas upon receiving and reading the Formulas ADV.